everyone, to episode 41 of Top of Mind with Consilio Wealth. Today is Friday, January 26th, 9:12 Pacific Time. And Hao and I are back to discuss what's going on in the news, as well as some interesting things that we thought we've experienced personally in the last couple of weeks. Hao, I am sick. Our son's been out of school all week. We tried to bring him yesterday. He made it about half the day, and they kicked him out because he had a rash on his body. So it's just been a week. It's been a week, but I'm here because the show must go on for the podcast. So nothing can stand in our way. Okay, today's episode, we're going to talk about a special CD rate that I got on my Marcus account. And I've talked about this a little bit in the past, so got an interesting email from them. Remember that 529 plan that I started a while back? I guess that was like 2021. Well, it's up. And I was reflecting on that, and I want to share that with all of you. Retail spending in December was again higher. Economic growth was really, really good. Once again, the U.S. economy continues to prevail. And finally, Hao has something called loud budgeting. I don't know what that means. So Hao is going to let us know what that means when we get there.
All right.
All right. So this CD rate that I got. So I have this Marcus account. Marcus is a Goldman Sachs product. It's a high yield savings account. Clients of ours would probably recognize that name too. You know, when they're asking us about high yield accounts, I'll typically talk about Marcus and the Amex account. There's other ones as well. I think Citi has one, or CIT Bank. And, you know, if you just Google high yield savings accounts, you're going to land on like NerdWallet or Bankrate, and you'll see kind of the top rated ones. Real quick things to look for are no hoops. Many of these accounts will have teaser rates that look really, really good, better than the average. But the hoops
But
are
on the first $500 or something like that, right?
on the first $500, or they're trying to get you to switch all your banking over.
Yeah.
So like make your direct deposit there, or make 2 debit card transactions a month, or that kind of thing. So just have an eye for that. My bias in these is just towards the ones that are simple. Park money, get interest, take money out. Interest is done. That's it. Okay, so I have a Marcus account. And I got an email earlier this week that says, special term, boost your savings. 14-month CD at 5.4%. Now, for context, my current rate on this account is 4.5%, just on money that's sitting in the savings account. So 5.4 is a nice bump, right? It's almost 1%. And it's locked for 14 months. Says, lock this competitive fixed rate today and enjoy a guaranteed return. Offer expires 4/17/2024, $500 minimum. And the APY may be changed before the CD is open and funded. Hao, what's your take on this? What are the banks trying to do by offering a higher rate and locking for 14 months?
The higher rate and locking, I think, from a bank's point of view, I think they want to maintain or even grow their deposit base. I think that's a bank like Goldman does have a lot of wings, but think of a traditional bank where they need to bring in deposits to therefore loan out money, right? So it really depends on the bank's business on the back end, meaning what are they doing with that money? Are they seeing an influx of auto loan requests or mortgage requests? Maybe not with these higher rates, but that's why you would need that capital, because you can't lend out money you don't have in the form of deposit, right? That's illegal, right? You're well below your reserve requirement. So you gotta, if you're maxed out in loans and you want to create more loans, the simple answer is create more deposits.
So my theory is that the banks are essentially trying to prevent a small run on their bank, and that they're betting on the fact that the Fed will lower short-term interest rates faster than long-term interest rates actually come down. Meaning, as the Fed lowers rates, we're all going to make less money on our high-yield savings accounts and our money markets and this kind of stuff. And at some point, we would be incentivized to pull that money and put it somewhere else. And that could cause then a lot of these deposits to go out. In fact, interestingly, I pulled money from this account recently, and they asked me to fill out a survey. They said, do you anticipate pulling this amount of money in the future? Do you anticipate on replenishing this amount of money and then doing it again. Was this a one-time thing? And then I think they even asked, like, where is it going? And the options were like, I'm buying a house, I'm buying a car, I'm paying taxes, that kind of thing. So they're quizzing on, like, where's the money going when it's leaving? Is it because of interest rates? That was an option, by the way. Oh, I got a higher rate somewhere else. So I think that they're betting on the fact that their money is a flight risk as the Fed lowers rates, and they're trying to lock it for 14 months because where's this money going? This money is ultimately guaranteeing their ability to do consumer credit, say car loans, credit cards, those kinds of things, which they're betting on that interest continuing to be higher and more profitable. Therefore, I need my savings deposits to continue to offer those, those credit extensions. That's my theory.
That makes sense, and it kind of runs counter to what we've been saying, where banks want to lock in lower rates for the longest possible time, right? Because they don't want to be paying 5% because they have in turn make 7% off of the corresponding loan to even break even sometimes, right?
Yeah.
This sounds plausible. We don't know yet, but again, we won't know Goldman's tactic there because bank reserves, especially in Goldman's case, because they have equity risk in there, they have fixed income risk, they have deposit risk. So they might be shoring something else up that they know they could get a better return on, for all I know. Pretty complicated bank relative to a regional bank or even I want to say Wells Fargo or Bank of America, but they're trying to push towards the Goldman type of investment banking model where their book is getting more complicated. So, it sounds counterintuitive, but the fact that they're offering that high of a rate with a lock-in, and I would probably look for what's called the call provision, where they say, hey, after 4 months, we have the right to give you your money back and stop paying you interest.
Yeah, when I looked at this, there wasn't a call provision. Let me
so there must be something else that they're needing that money for.
Because there's a little, let's see, $500 minimum, lock in this rate, 10-day CD rate guarantee. So this is as of January 22nd, just a couple days ago. Penalties that may reduce the CD earnings are withdrawal prior to maturity. I don't believe there's a call feature on this.
Yeah. So pretty rare instance now, because I did check inventory, and a lot of CDs are paying about 4.5%. That's a big drop off since the last time we brought up CD rates here on this episode or this podcast.
Yeah. So I think they're trying to get out ahead of it, right? Because if they start seeing deposits go, then they have to hold their rate or even raise their rate to try to incent money to stay. I think they're trying to get out ahead of it by offering these CDs.
Yeah.
And then they can just plan too. It's like, hey, I know I've got money for 12 to 14 months. And if rates go down, who's going to break it? Who's going to pull their money before 14 months? Nobody. No. I guess people that need the money. But
well, again, I think there's a lot of people who are still sitting on traditional savings account that's yielding less than 0.25%.
Yeah.
Because they don't look at interest rates or care to move their money around.
Yeah. Interesting. Okay. Well, I'm curious, our listeners, is anybody else getting emails like this? I know that many of you have these high yield accounts now. Are you getting emails from your bank that says buy a CD and it's like about 1% or a little more, a little less than your current rate? Are you taking it? What are you doing? Just would be curious to hear from everybody out there.
And I think we said in our year end, right? Like, don't fight over or do spend a ton of time researching a difference of a percent on your savings. If you could lock in and you're getting an offer like that from Goldman, like Chris did, jump on it. But I would say don't spend a ton of time researching which bank offers the highest yield. If you're scraping for, a third of a percent difference, it's not worth the effort.
Sure. Yeah. In another account, moving money, another tax form, all that stuff.
And you got to transfer it, and if you have auto pay linked up, you got to reestablish all that. That's probably a big reason why people haven't moved off their Bank of Americas or the low yielding checking and savings. Because it's so interrelated to everything, right? But if you get a CD
I've been
like
with the same
that,
bank.
Yeah.
I've been with the same bank for probably 25 years. As crazy as
Yeah.
that sounds. Don't move. So, all right, I want to shift into this 529 plan. Remember that? Remember the 529 plan that I was griping about a few years ago? So we started a 529 plan for a son. We started funding it. And we started this thing up in 2022. Everybody remembers the market in 2022. It was up, down, up, down, up, down, but mostly down. And then it kind of pivoted and started going up towards the end of the year. But it was a bouncy year. Now, you remember that I commented on this quite a bit because I bought and then I was immediately down. I was like, oh, God, like, of course. I knew it, right? And then it went up and I was like, oh, man, I wish I bought more. I knew it. Well, for context here, so I ended up putting in roughly a third across 3 transactions in 2022. So the dates of these, so August 16th, August 16th. Yeah, that was like one of the times right before everything fell. Of course, right? August 16th. I remember talking about that. Then I did more on September 2nd. Almost clipped the bottom. September 2nd. No, I'm sorry. September 2nd was kind of one of the near-term highs, actually. So 2 at the near-term high, and it's like, oh, really? Then the final third on September 26th. September 26th was almost the bottom. It looks like things bottomed on 10/1/2022, a little bit lower on 10/15/2022. Yeah. So darn close. Well, what I wanted to share is today I'm staring at this account, and I'm up 24.22%. And the only thing that I'm wishing is that I put in more money. Mm-hmm. And so I was just reflecting on that, right? Because I don't know that I've ever opened an account before and put in kind of a sum of money and then just let it sit. Like, I'll put in money, I'll trade something, I'll buy something, or I'll put it into our model portfolios and the company manages it, or, and then I kind of admittedly lose track of that specific investment, right? But this went into one thing across those 3 purchases, and I'm up 24.22%. Man, why didn't I do more?
Yeah, so this was the best feedback that I've gotten for your story, your personal story. Everyone loved that. You're pining over, what came out to be literal days difference.
Yeah.
The market was, again, to go back to 2022, the market was moving. Like, it was not a fun time to invest. Turns out the bottom was that June, but it doesn't mean that we had ups and downs. I think the feedback that I got was you're kind of like everyone else, where I wonder how many people invested all their investable dollars at once and then never look back. Mm-hmm. I know that's like the common advice, but who does that? Like who has the guts to do that?
Well, and my theory was we'll contribute to this over time consistently. So it's not all our money.
Yeah.
But also what we tell clients if they had a lump sum of money is either go all in now.
Yeah, we say time in the markets, right?
Or put in 50% now and do the other 50% over like 2 to 6 weeks. Interestingly, we're all trained to dollar cost average to fund it. We all do it with our 401ks. We all do it with monthly investments. But I encourage everybody to Google dollar cost averaging versus lump sum investing. What you'll find is that lump sum investing always outperforms unless you perfectly time the top and you perfectly bought at the top.
Yep.
And that's because you're in longer, you got more dividends. Generally, the market goes up. So I knew that, and I wanted to get all the money in on, in a relative short period. And then, when the market fell, I did what, we tell any of our clients would do, and I bought more. So anyway, I just wanted to share that with everyone. I thought that was helpful, or I hope that's helpful. Just a personal reflection on like, man, isn't that true for all of us? Like, whenever you make money on something, don't you always wish you bought more?
Yeah.
Like when COVID...
Flip it on you.
Yeah.
Yeah, go ahead. Finish your thought.
Last thought was when the markets tanked in COVID, I remember that we sent out a call for cash email to all our clients.
Yeah.
I put in money to my own accounts personally. We all did fantastic on that, We know it'll be okay over time. And, that was probably one of the best investments I've ever made in my life because I bought it
It was
low.
the scariest in the moment, though, too.
Trust the process, though,
Yeah. Yeah. So if I'm going to flip that on you. So let's say 2023 was pretty bad. Like it was another 10% down after a 20% down 2022. Would you be saying the same thing? What would your level of regret be with those summer dollars in 22 now if things went according to the way everyone expected? To be fair, you invested because our internal outlook was pretty tepid and somewhat negative. We were still holding out hope, somewhat optimistic, but we weren't screaming 26% in the S&P at all, right?
Nobody was, yeah.
So if 23 was the way we expected, how I know it's kind of hard to go in the alternate reality, but how would you react versus now?
So what I like to keep as a mindset is if you made an investment and or if the market is lower, the mindset is you have the opportunity to buy at a price that is lower than it was in history with money that you didn't have back then, right? Because we all earn money like a paycheck, right, over time. And so if markets go down, that's my opportunity to buy back, a year ago or 2 years ago. And that's when we sent out that email when the markets crashed in COVID. We said, look, the markets have retraced to, I don't remember what it was, 2015 levels or 2016 levels or something. We're like, we don't know where the bottom is, but if I could buy more in 2015, I would do it, knowing what I know now.
That's good perspective, yeah.
And so that's what I think about when things go down is I have the opportunity to buy at yesterday's prices with money that I didn't have yesterday, but I have it today.
Yeah.
So I would have bought more.
Yeah. And again, hindsight's powerful because the fears are kind of erased. I could tell you, entering 2023, there was a lot of fear, and not a lot of people were, willing to hand over money to invest to their investment accounts. But now the attitudes have changed. Now that we've, again, the results still may come in with recession or not, but it looks like things are improving pretty greatly, right? And everyone's suddenly brave about investing in 2023. Oh, should have done this, should have done that. I was like, well, that's not investing. And things are down typically for a reason. They don't just sell off and give you an opportunity to jump in when things are good. That's pretty rare, right? So I think that the money's typically made in 2022 when you start building that foundation for those unexpected 2023s.
Yep. Buying in the face of that, the crazy headlines in the news sure worked out last year.
Yeah. Easier said than done. I could tell you that.
Easier said than done.
Yeah, we were there's there's a level of fear that we had, and it's just not easy to overcome emotionally, especially when you're putting in significant amount of dollars to something so uncertain.
Yeah, and we had a lot of people. I mean, I can't tell you if it was more than the average or less than the average. We have a lot of clients that are funding their accounts here. Maybe it was about average, about in line with what we would expect.
Yeah.
I know that was harder to do last year, but look at it now. Don't we wish we did more?
Yeah.
And in the face of, I could just leave it in cash and get 5%. That feels pretty good. So
yeah, but you still had let's say it was all 100% S&P, which I think is unrealistic, but there's still 21% opportunity cost there, right?
Totally.
That's a huge gap.
Totally.
Especially if you're young. You shouldn't be thinking of that as a long-term viewpoint.
It comes back to as well, because we were talking about like the data, right? When markets have a down year, like 2022, what do forward-looking 12-month returns look like? And
we rely on that when things were pretty ugly.
Yeah, and they were very good, right? And it's like generally, and again, like let's zoom out and let's think about this from a 30,000 foot view. Like generally, well-diversified portfolio doesn't go on forever. So if we have a bad year, the forward-looking 12 months generally looks pretty good. Yeah, and it's kind of the same thing with bonds. If we survived 2022 with what bonds did, the worst return in 100 years, we made it. Probably won't have to go through that again for another 100 years. That's good.
Yeah.
And invest, feed forward. And now, now bonds are up this year because rates have come down a little bit. And of course, market's up in the trailing 12 months.
Yeah. Yeah. Wild where we've come from your son's 529.
Yeah. As you would say, invest as if we don't know.
Correct. Who knew, right? Who knew? And you only know in hindsight, and I always say, you don't get yesterday's price. Good luck finding someone who's willing to give you a 26% return if you bought something today. Good luck. And that's, again, I know we're talking with hindsight right now, but I totally get that. It's a lot easier said than done.
Let's shift over to some economic data here. So retail spending in December was very good. Seems like economic data was really, really good. You've got some comments here in the deck and in an image, which I don't totally understand. So maybe I'll just let you run with this. Share with us what's going on in consumer spending and just the strength of the economy.
Yeah. The chart, Bank of America published a chart where they saw their consumers' spending habits were. And it wasn't in basic needs. It was all almost the uptick in additional spending to just kind of widen out the lens here. We've got December retail numbers and they came in higher. And everyone was expecting a slower Christmas because everyone was tapped out through inflation and higher rates. And guess what? The unexpected happened. And it just seems to be the consistent story through COVID and post-COVID. As a result, GDP for the U.S. had been coming stronger than expected for the last quarter. So this is like the good news keeps piling on in terms of the resiliency of the American consumer, which represents about 70% of GDP. So to focus in on that Bank of America report, what did people spend on in the last year? And most of it was travel and entertainment in terms of volume and number of transactions. So volume increases make sense because inflation is higher, everything's more expensive, right? Booking a hotel at the Hilton, something got more expensive, therefore spending at hotels goes higher, right? That, let's say 100 people book hotel rooms, but the cost is 20% higher, you would expect 20% revenue increase for the hotel, right? So, what we did not see was a leveling off or a decline in transactions. We actually saw a 9% increase in travel and entertainment. And this is number of transactions, so that strips out the effects of inflation. So inflation or not, people were spending money on discretionary, right? Because travel and entertainment is probably not a need, rather a want, right? Food transactions, the number of transactions actually grew by 4%, while the revenue of food spending grew by 5%. So we all harp on food inflation, but we're spending more on actual quantity of foods. So I think that's what the story's been painted all last year. In spite of higher rates and higher prices, we are blowing past all that and spending in terms of quantity a lot more than what we used to in 2022.
I bet that's food at home too. So food at home is up by occurrence, 5%. So transaction numbers, more swipes at the grocery store. It's also more expensive.
Yep.
My eggs are back up in price.
Oh, yeah.
I can't believe it.
We have a personal chat where I get regular eggs, and Chris admonished me for that because I pay, I think, $4 for 18 eggs.
Dude, you don't want to be putting those eggs in your body. I'm telling you.
I think he pays $13 for 12. Is it $13 for 12 dozen or 18?
It's for 18.
What kind of eggs are these that you're buying? That seems so high.
Dude, these are pasture-raised organic eggs. They're exceptional. Eggs are really important in your diet. They
Is the yolk orange or?
Yeah, the yolk's beautiful, lively. You want to eat it instead of like a muted, gross yellow color. I mean, you're laughing, man, but I would. Next time I'm at your house, do not serve me eggs. I'm not eating those.
Or I'll just.
I'm not putting those in my body. Whole Foods and spend $50 on a pack of eggs.
Whole Foods and spend $50 on a pack of eggs. Or I'll just go to Whole Foods and spend $50 on a pack of eggs. Or I'll just go to Whole Foods and spend $50 on a pack of eggs. Or I'll just go to Whole Foods and spend $50 on a pack of eggs. Or I'll just go to Whole Foods and spend $50 on a pack of eggs. Or I'll just go to Whole Foods and spend $50 on a pack of eggs. Or I'll just go to Whole Foods and spend $50 on a pack of eggs. Or I'll just go to Whole Foods and spend $50 on a pack of eggs. Or I'll just go to Whole Foods and spend $50 on a pack of eggs. Or I'll just go to Whole Foods and spend $50 on a pack of eggs. Or I'll just go to Whole Foods and spend $50 on a pack of eggs. Or I'll just go to Whole Foods and spend $50 on a pack of eg
I mean, if you bought
So-
enough of them, you could spend $50 on them.
So
Anyway, they
bring
went from
everyone in-
$11.50 to
13,
to
right?
$12.99, which is just like atrocious.
But we're seeing nationwide
Ah.
charts of eggs come down from that, the avian flu drama last year. Which
Can everybody email me if
average-
you're buying the same eggs as I am? I know everybody is. Just how's this is from Vital
think you're-
Farms. Vital Farms. I'm looking up the stock right now. I'm sure they're crushing it on profits. Maybe I should buy some. They're down 2.5% today. Let's see.
You said Vital Farms?
Yeah, Vital Farms.
Okay.
They're publicly traded. Anyway, sorry, I interrupted you. You got me down the egg train again. So
Well, I just think it's crazy to spend that much on eggs. But we look at nationwide average charts, and the cost of a dozen eggs nationwide is just like $3. I'm in California, so we pay about $4 for, but it is for 18, so that it might average out to the nationwide average. So
$4
$13 for $13.
where are you
for a
buying
dozen
these
eggs.
eggs? Costco?
We sometimes Costco, yeah. So the price is going to vary because it's by the pallet. So I didn't
Yeah,
do the
that's
math on
right.
how
Yeah,
much-
Costco's got like a lot of eggs.
yeah. So yeah. Let us know if you're spending. You could beat Chris's record in egg buying.
You are. You can admit it. You can email me. Everybody knows you're buying these 18 packs of pasture-raised eggs.
That's
good.
so expensive.
Once you do it, you won't go back.
Yeah.
Just one time, Hal. Go buy those. Crack one in the pan, and then crack one of your $4 eggs in the pan, and tell me which
Yeah.
one you actually want to eat. Just do it, and send me a picture.
All right. Yeah. My neighbors do give us. Sometimes they stopped recently, but both neighbors on the sides of us have chicken coops, and sometimes they give us eggs, and that's why I'm familiar with the deep orange yolk versus the store bought
See,
pale yellow.
pasture-raised eggs on pasture in Sacramento.
Yeah.
Out in the open
tastes the same.
field, they're
It tastes
running
the same
around.
way.
You know that free range means like they're just all in a huge factory. Like they're just not in a little cage. Like
They just have a foot.
It's bad
Yeah, a foot.
advertisement.
Yeah.
Yeah.
All right.
My hens
It's
have
really
I
weird
think it's
rabbit
103
hole.
square feet each. It's really good.
Really?
It's really good.
That's
We
more
want
than mine.
chickens, by the way. So
That's bigger than my house. You're
It's
going to
not
get
bigger than
chickens
your
for
house.
your
How?
property?
we want to, because
Okay.
egg prices keep going up. Man, can't afford these things. I think it's cheaper to buy a chicken. You know?
Yeah. You could have bought 17 chickens in this year alone, and it's only 26 days.
I
in.
think we could. I mean, how much is it? How much is a hen for-
Well, you think about the feed and the coop, right? Because you can't have chickens roaming around. They're going to fly to neighbors' yards.
egg laying?
which-
This is
which
according to
happened to us.
Google. Egg laying hens run between $20 and $50.
Oh,
That's
yeah,
it?
you would save a boatload if you did that. Even
Let's
if you
see.
paid
And
the upper
speaking
end.
of running, okay, we would need a coop. You can buy a coop
Yep.
for as little as $160. Okay, so let's say that cost me, $200. I don't know, and then $50, and we probably need like 2 of these, right? So okay, so let's round here. So for $400, I don't know what you feed them though.
Chicken feed.
So for $400, chicken feed. Yes, thank you.
But how many eggs do you consume a week? Is it the 18?
Yeah, we eat a lot of. We probably eat 5 eggs a day.
So 13. So you're spending $52 a month.
When you put it that way. Okay, so 31 cartons of eggs is my break even. And so I said 5 eggs a day. So 5 eggs
Yeah.
a day, 18 divided by 5 is 3.6. So what, in like 10 weeks I break even?
That's wild. But again, there's other costs, right? The time and effort to take care of the chickens, right? I don't know if you have coyotes
Yeah.
out there. I doubt you do, but there's predators, there's maintenance, there's chicken poop everywhere on your property, right?
Oh. I don't need that.
Yeah. One of my neighbor's
see,
chickens
so-
flew over the fence, and we had to chase the chicken down like I was Rocky. You know how hard it is to chase a chicken, And
They're fast,
you pick
right?
a live chicken up. Yeah, picking a live chicken up, they like surprisingly strong. But the neighbor showed me how to finally corner one and grab it. It's happened a couple times. So
hens are expected to produce about 300 eggs annually. Yeah, so 2. I guess we'd have to kind of wait to stock up a little bit. We might need 3.
yeah, maybe you get to a point where you can't even consume all the eggs they produce, because that's happened quite a few times.
Yeah. How many do they
Speaking for
have?
my neighbors. Oh wow! On both sides of us, they have probably more than 20.
What?
Yeah, yeah.
I was thinking like just, 2, but wow.
Well,
Okay.
yeah, 300, 600 eggs for 2. That's still a lot of eggs.
Well, we've definitely gone down the egg rabbit hole. You should have recorded me there, so thank you for the...
Yeah, everyone who's turned off.
there.
Yeah.
Once again, email me that you're buying Vital Farms, pasture-raised, organic eggs in the 12 or
email
18
me
pack.
if
We all know
you're,
the 18 pack's a
more
better deal.
moderate with your eggs.
Email me if you're spending $4 on 18 eggs. I know you're not. I won't get any emails on that. All right. Anything else on this consumer spending thing? I think this is super interesting here, what you're talking about.
Yeah. So again, this kind of leads into the vibes of the recession, right? People think things are bad, and their wallets aren't showing that at all. Maybe it's a small percentage that's overspending that's making up for everyone else. I doubt that, especially with the numbers we're seeing. It's a collective we, where we are overbuying. We're buying more, or we're booking more, or we're traveling more. Whatever the case is, we're spending a lot more, and that's even adjusting for inflation.
Consumer confidence has jumped a significant amount too.
Yeah,
And we were talking
big
in
jump.
June. Yeah, so it was at a lower than '08. Remember that?
Which I think is crazy.
Crazy.
That's one of the like, anyone who's filled out that survey during that needs to get kicked off the survey.
I wanted to tell you, I got an email and I was so
You
excited.
finally got a survey?
No, I thought it was. I got an email from this. It was the census, and I was like, nah, the census doesn't seem right. So I clicked on it, and it was much more just around like how many people are in your household, how many people under 12, that kind of thing. But I really wanted to answer the economic questions, but they weren't there. So I actually just didn't complete the survey because that's what I wanted to do. Anyway, consumer confidence bottomed at around 50 June of 2022, which is just insane. For context, it was like 55 November of 2008. So people felt worse in June of 2022 than they did in November of 2008.
Yeah.
Wild. And today it's all the way up at around 70, which likely plays a role in spending. I think, for much of the year we were talking about this revenge spending, like, we're going to go into recession. I'm just going to buy now because I won't be able to buy later. Now people are actually feeling pretty darn good. And a lot of that is credit to inflation coming down.
Yeah, and gas prices too, because you could see.
Which is a big part. Yeah.
Yeah, they're inverse of one another. And again, we've been saying your mood shouldn't swing with gas prices. I
Mine
get
does.
that it sucks, but yeah, it's...
And egg prices. Gas prices and egg prices. Those are two things that swing my mood. But really, I mean, gas, like, because you fill a tank and it's like a lot of money. And
It's painful,
so
yeah.
It's painful. Mm-hmm.
I get it. But again, I don't get that it was 2008 levels, 2008, below 2008 levels. I know gas prices were really cheap in 2008 because there was no demand. Like, everything ground to a halt. And again, I look at things from typically an economic lens.
Let's shift over to, so you talked about loud budgeting. I don't know what that means. So what does loud budgeting mean?
Yeah, it's a TikTok trend, so I don't know how much life this has. But this is kind of in stark contrast with the spending that we're seeing from Bank of America. Loud budgeting means it's people saying, I can't afford to do this. I can't afford to go out with my friends, and telling them versus coming up with an excuse, right? You're being open about your finances and your budgeting, where it is in stark contrast for the way we've been raised for all these generations, where money topics, personal money topics, have been taboo. And I think loud budgeting is trying to shift that, where I'm open, not just to my family, but to my friends, that I can't afford this, or I value this more than that. Meaning, I value Starbucks coffee daily more than gym memberships, right? So if you're spending $200 a month at a gym or $200 a month in coffee, who's to judge you, right? I hope this sticks. I doubt it will, because it seems like TikTok trends seems to last a week. But the previous trend was, like an explanation of budgeting. So if I bought a $5,000 purse and I use it 500 times, the cost of that purse ends up being, $100 per use or something stupid like that, where it's like a justification of luxury goods, where, that was a trend just a few months ago. So that's why I'm not convinced that this will stick. But I think there's some real good at the heart of this, where if you're trying to change the dogma of, I'm not going to talk about finances, or come up with some lame excuse that I can't afford to go out with my friends, rather than just tell them I can't afford to go, to this luxury dinner with you guys, because you go twice a month, and it's a $500 tab every single time. We get that it's more likely the minority there, because the data in terms of actual spending, like what people are saying versus what people are doing, it's still in contrast of what's happening, right? Like the number of transactions is so high that someone's lying. And I'm pretty sure these loud budgeters who are saying they can't afford things, but they're probably going out and spending it in other places.
Well, it's interesting because the B of A study is, I'm trying to read the fine print here, but I am assuming that it's much more national, different age bands, probably people that are older. We do know that TikTok tends to skew on the younger side. And so it's really a window into what young people are doing. And I'll just read this here. So it says, the loud budgeting trend encourages consumers to take control of their finances and be vocal about making money conscious decisions, rather than modeling purchase decisions after celebrities and their bottomless pockets. I think that's super interesting, right? Because to keep up, it's like, I need $1,000 car payment. I need to go get, my shoes need to be white everywhere I go, that kind of stuff, right? And that costs a lot of money.
Yeah.
So so it's not the I don't have enough, it's the I don't want to spend. And so that's kind of the other I think tweak here. So it's I can't afford it, but it's also like I don't want to go spend money on that. It's less about keeping up with the Joneses, as they would say, and more about making conscious decisions.
To me, I think that's so empowering, where you're saying, well, my neighbor drives a Mercedes. I suddenly could care less, right? Versus previously, well, I need to get a Mercedes to keep up with them.
Yeah.
Right?
I think it's interesting. Every Morgan Housel talks about this in his book, The Psychology of Money.
The goalpost.
For everybody's... Right? Say again?
Go ahead. Sorry.
No, sorry. What were you saying?
Well, he was mentioning people tend to move their goalposts further and further out the more and more money they make. So their expectations go up in terms of their actual reality, and their expectations are always out of reach of the reality. And, you could see $400,000 earners are perpetually unhappy because their expectations are so sky high.
So also true, and actually I was going a slightly different direction there, but that's really good perspective, right? I think for the TikTok world, they might be associating themselves with that $400,000 earner, frankly, the $8 million earner who's a celebrity, right? Which is like totally different. And trying to compare themselves to that person. Where I was going was, it's shown that over history, the environment that we grew up in and what we experienced as we grew up has more of an impact on us than what we are taught. And so people that grew up in a super high inflation environment, when we went through and are kind of still going through it now, higher inflation, they're panicked. Versus people that grew up in incredibly low inflation environment, they don't know anything about inflation, and inflation going up is like, whatever. People that remember gas lines, they're that's imprinted in their brain. And so throughout all times of economic history, we all have these imprints. So obviously, we know some of the data with like millennials and the people that graduated in 2008, 2009 into one of the worst job markets ever, or even right before then got hired and then immediately got laid off, couldn't find a job. My curiosity is around this exact topic. I wonder if people are going, wait, I don't want to go spend on dinner because I can put it in a high yield savings account and I can earn 5%. And if I put $1,000 in there, I could pay for my coffee all year via interest.
Yeah.
Like, I hope that's what's actually happening behind the scenes. Like, higher interest rates are promoting saving and then savers, and that's actually teaching some financial acumen to young people. How beautiful is that?
Yeah, I talked to my younger self where 25% APR on credit cards. So if you're no longer carrying any debt from month to month on a credit card, I think that 5% savings yield is the delta of 30%, right? 30%.
Totally.
30% in 4 months doubles your money, more than doubles your money. So, or doesn't take away from your money. Meaning if you have $1,000 in debt that you're carrying all year, that's a $300 delta that you're looking at versus putting that $1,000 in savings.
I wonder if young people are putting money on credit cards or just what I mean, I remember when I got my first credit card, I think it was a $300 limit. So like we're talking, you couldn't even get yourself into trouble on the thing. I wonder if young people are getting bigger credit card, $2,000 and stuff. Like, I don't know.
Oh, yeah.
And I don't know if they're running it up. I don't know if they're carrying a balance. I don't know if they're paying 25%.
Or using their parents?
Maybe, but I mean, I don't know. It's interesting. I mean, maybe they're not paying cash, but
There's buy now, pay later, but still, there's an upper limit to that. Where again, you're buying a $7,000 purse. Yeah, that's a very high payment. So.
Yeah, it is more affordable though. I know there's data on. We don't have it here, but I know there's data on the amount of defaults with the buy now, pay later. It was supposed to be great, and young people liked it because they didn't like credit cards. And then there's like a super high default rate. I won't quote it because I don't know, but it's quite high. And then those basically become payday loans, and they're insanely high and not great.
Yeah,
but. Interesting. Well, hey, good discussion today. This was fun.
Yeah, that was fun.
I think it'll be, if Morgan Housel writes a third book and talks about, the 2023, 2024 kids, maybe 10 or 20 years from today, I think that'll be fascinating to see what the incentives were today and what ultimately or how that shaped them as future consumers as they come of age in the next, 10 to 20 years.
No, and I think it'd be interesting to see what our imprints are in 20 years from now. Yeah. Are we going to talk about this moment about high inflation, even though it only lasted 18 months? Maybe.
Yeah. All right. Thanks everyone for tuning in today. We hope that this was a fun discussion. It's certainly fun for us.
Yeah.
And we'll catch you again in 2 weeks.
All right. Make it a great one.